In this lecture, I wanted to discuss various ways that you could short stocks, commodities, and other markets. Going short basically means placing a bet that an asset will decline in price. Shorting can be a risky strategy, but can also be very profitable if done correctly. When the market is in an uptrend, this is called a bull market. When the market is in a downtrend, this is called a bear market. Most people are familiar with purchasing stocks during bull markets in hopes that their purchase will increase in value. But learning how to use methods to short stocks during bear markets will help you capitalize on a stock's decline as well. There are multiple methods you could use to short an asset. The most popular way to short the markets is to place a put option. A put option allows you to sell a stock or an asset at a set price either on or before a selected date. If the asset falls below the set price before the selected date, you get to keep the remaining profit. Options trading is a more advanced method of trading, but for this course, I wanted to introduce you to some easy methods to short the markets without using options. I will likely cover options trading in a separate course in the future. My favorite methods to go short without options are using inverse ETFs and also using the Volatility Index, also known as the VIX. An inverse ETF is an exchange-traded fund that is made using various derivatives in order to profit from the decline of a market. The Volatility Index, or VIX, measures a market's expected volatility. When a market declines, the market volatility increases, and you're able to capitalize on this volatility increase using the VIX. Using inverse ETFs or the VIX is just as simple as purchasing any other stock or ETF. So let's go over each of these methods in more detail. First, let's go over how to profit from a market's decline by using an inverse ETF. This is probably my favorite method to easily short various markets when trading. There are dozens, if not hundreds, of inverse ETFs you could use for trading. These can range from inverse ETFs to short the markets of different countries such as Russia, bond or stock market indexes, or even to short commodities like gold or oil. We will go over how to find various stocks, ETFs, and inverse ETFs in an upcoming lecture. But for now, let's compare an ETF with an inverse ETF and also check out the Volatility Index. In order to view multiple charts at the same time, I'm going to be using stockcharts.com. They allow you to compare charts side by side using a tool called Candlestick. So from the stockcharts.com homepage, you want to look up at the search bar and click the drop-down menu to the left. They provide you with multiple options to choose from, but for this example, we're going to select Candlestick. So for our first example, let's compare the S&P index with the ETF for the S&P and the inverse ETF for the S&P. The stock symbol for the S&P 500 index is the $SPX. You can see it here as the S&P 500 Large Cap Index. In order to add another symbol to our Candlestick, simply separate them using commas. SPXL is the Direction Daily S&P 500 Bull 3x shares, which actually follows the movement of the S&P. This is a 3x ETF, which means the ETF price should move around 3 times the percentage of the S&P itself. SPXS is the Direction Daily S&P 500 Bear 3x shares. This is a 3x inverse ETF and can be used to easily short the S&P. So let's compare these three charts using Candlestick. So here you can see a side-by-side comparison of the S&P index, an S&P ETF, and an S&P inverse ETF. If you wanted to capitalize on a rising S&P, you would purchase XPXL. If you wanted to profit from a decline, also known as shorting, you would purchase SPXS. So as you can see, XPXL pretty much follows the exact same pattern as the S&P 500 index, but SPXS does the exact opposite. So when the S&P 500 index is going up, XPXS is going down. But if the S&P 500 index is going down, SPXX goes up, giving you a great opportunity to capitalize on the S&P's decline. So using both XPXL and XPXX, you can make money whether the market goes up or goes down. There are many other ETFs available that follow the S&P and other indexes, and we'll go over how to research and locate these later in the course. Stock markets are not the only assets you can short, but you can also short commodities and other assets such as the US dollar. So as an example, let's check out the US dollar index, an ETF for the US dollar, and an inverse ETF for the US dollar. The stock symbol for the US dollar index is the $USD. The stock symbol UUP is the ProShares DB US Dollar Index Bullish Fund. This is an ETF that follows the price movement of the US dollar. And the stock symbol UDN is the ProShares DB US Dollar Index Bearish Fund. If you see the word bear or bearish in the title, it's pretty safe to say it's an inverse ETF. So here's a side-by-side comparison of the US dollar index, an ETF for the US dollar, and an inverse ETF. As you can see, the dollar ETF UUP pretty much follows the exact same pattern as the US dollar index. The US dollar went on a pretty good run at the end of April, and so did UUP. But as the US dollar was going up, the inverse ETF UDN was going down. So when the dollar is in an uptrend, UUP would probably be a good option. But if the dollar switches to a downtrend, you may want to switch over to the inverse ETF UDN. Another great way to capitalize on a market's decline is to use the Volatility Index, also known as the VIX. So let's compare the S&P 500 with the VIX ETF and an inverse ETF for the VIX. The symbol for the S&P index is the $SPX. XVXY is the ProShares Short VIX Short-Term Futures ETF. And UVXY is the ProShares Ultra VIX Short-Term Futures ETF. The VIX can be a little confusing, so let's head over to our candle glance and get a better view. So here we have the S&P 500 index, XVXY, which is actually the inverse ETF for the VIX, and UVXY, which is actually the regular ETF. Since the VIX already naturally trades opposite of the markets, the VIX inverse should look similar to the S&P 500 price movement. SVXY is actually the inverse of the VIX and trades almost parallel to the S&P. UVXY follows the VIX itself, and you can see that when the market's in an uptrend, volatility decreases and the VIX declines. So when the market is in an uptrend, SVXY would probably be your best option. But when the market starts to decline, you should probably switch over to UVXY. There are hundreds of ETFs and inverse ETFs available for markets, commodities, and other assets. We will go over various places to find these later in the course. But for now, let's go over trading exchanges and create your trading account. I'll see you in the next section.